It's late last night, and in preparation for this video, I'm reading the headlines on the forecast for the inflation numbers, and they were far from positive. The experts expected inflation to hit 7%, and the UK was being compared to Argentina.
Argentina is a country that never misses an opportunity to miss an opportunity.
I mean, at least you can win an international tournament. Jeremy Hunt earlier in the month had echoed this sentiment and said we're going to see a blip in September, and expected the inflation numbers to rise as well. All of the experts were betting that inflation would tick up to around 7%. Then we woke up this morning to this.
The Bank of England have confirmed that UK inflation has unexpectedly fallen in August.
Jeremy now claims that the government's plan to deal with inflation is working, plain and simple.
Simples.
I mean, I love that. A few days ago it was, oh, everybody prepare for a blip, but don't worry, that's all part of the plan. We get no blip, and instead the numbers fall, and we get, oh, see, the plan is working. Plain and simple. I mean, it's kind of a bold claim to say the plan is working when the overall rate of inflation has dropped from 6.8% to 6.7%. I mean, at that pace, it's going to take about 4 years to hit the 2% target, and a pint of milk will cost like $6,000 by then. Okay, I'm being a little bit facetious, and there is some better news in these numbers, some positive movements, and we're going to take a look at those in a minute. But first of all, let's just look at why all the forecasters are wrong.
I expected the number to go up.
It's pretty interesting, isn't it, that everyone knows economic forecasts are extremely unreliable. The Bank of England gets their forecasts wrong all of the time, and we just looked at how the ONS messed up GDP to the tune of 44 billion. We know this, but the world still celebrates when the numbers come in better than the forecasters thought. Like I said, inflation is 6.7% instead of 6.8%. I mean, doesn't sound great, does it? But everyone thought it would be 7%, so, you know, that's awesome. In this case, though, I can kind of see why everyone thought inflation would be higher this month. There was this huge surge in oil prices per barrel through August, which led to higher prices for consumers.
Up 30% in just a few months.
We can actually see these increases in the cost of fuel reflected in this month's inflation data. You can see this uptick here in motor fuels. Notice how the rate of growth in motor fuel is still negative. It's gone from negative 24.9% to negative 16.4%. So that means in the last month that prices have risen. So far in September, prices have continued to rise. And if that continues, we will see more upward pressure on the overall inflation figure from this part of the basket of goods. People expected that upwards pressure to push the overall inflation number up, but it didn't. So that means other components must have fallen by more than expected to counteract this. Let's just take a quick look at what's risen and fallen in the data. We've seen declines in the rate of growth in miscellaneous goods and services, restaurants and hotels, recreation, culture, health, furniture, and the big one, food and alcohol, where the rate of growth has fallen by 1.3%, but it still sits at a very alarming 13.6% growth. I mean, just consider these growth rates are compounding on the previous year's growth. So food prices are still going up by a scary amount on top of the price increases we've already seen. But this drop in food price inflation marks one of the biggest counterbalancing forces to the rise in fuel prices we discussed a second ago. Okay, so for months now I've been harping on about the fact that it's the core numbers that matter. This is the inflation rate after you strip out things like food and energy, because the core numbers say more about how sticky and persistent inflation is in this country. In a service-based economy like the UK, if the service inflation numbers are going up, then we have a problem. So let's just take a look at the core numbers. Core CPI excluding energy, food, alcohol and tobacco rose by 6.2% in the last 12 months to August 2023, down from 6.9% in July. That is a drop of 0.7% in the core numbers. The goods component of the core numbers actually rose by 6.1% to 6.3%. You know, goods as in products you buy, something you can touch, whereas a service is really when you pay for someone's skills. The service component fell from 7.4% to 6.8%. I, of course, would have liked to have seen these numbers fall more. The inflation target's 2% and we're well off that. But I've been saying for months that these core numbers need to come down. And now that they are, or they have this month, I'm not going to sit here and say this is bad. It isn't. It's a move in the right direction. And without the upwards pressure of oil in August on the overall CPI numbers, the headline rate today would have looked even better. But I am reluctant to sit here and say everything's great, this is all over, because it isn't. There's a problem with the CPI data, really. It's the data that hits the headlines and it's the one we all talk about, but really it fails to capture the reality for us on the ground. And I'm not talking about the fact that prices are still rising just at a slower rate. What I mean is that CPI's exclusion of housing costs is probably missing off the biggest concern now for most people watching this video. So CPIH is the CPI data including housing costs, the H is for housing. If we look at the components that make up housing costs in this graph, it paints the picture that many households face right now. In light blue, we can see the falling away of electricity and gas price rises. We can see this massive rise here and then the falling away here, which kind of symbolises how at one point Energy costs were the biggest concern for households, but that has changed, and every other cost associated with owning a home is increasing. OOH, or owner-occupier housing costs in purple here, is the most dramatic example of this. This includes mortgage interest payments, but rents are following the same path, of course. In order to combat inflation, the Bank of England have increased interest rates, and the knock-on effect of this is it will increase housing costs for both owners and renters, as homeowners and landlords alike deal with higher costs on mortgages. Yes, the CPI numbers are falling, so the growth in prices across the goods and services we're buying might be declining. But now it sort of feels like to me that the symptoms of the medicine are becoming worse than the disease itself. Everyone needs to live in a home, and all forms of housing cost are rising. So while we might sit here and go, oh look, CPI is 0.4% less than a load of analysts expected, so that's good news, CPIH is the whole picture. And the story that's telling is that the pain around maintaining our homes is increasing. At the same time, prices continue to rise around us, just not as much as before, and definitely not as much as analysts expected them to. So yes, core inflation is down, and I will say that that is good news. But I also want to acknowledge that the housing cost piece is having a massive impact on all of us, and that will continue to rise and will continue to get worse for many. This chart shows it pretty clearly. CPI and CPIH falling slightly, but owner-occupier housing costs are picking up steam. And this will just get worse as more and more people come off fixed deals, both homeowners and landlords, and mortgage rates and rents will continue to rise as a result. It's the reality of an economic policy designed to create a problem over here so we can solve a problem hopefully over there. It's all by design. Raise rates, make borrowing more expensive, taking money out of people's pockets because they now have to spend it just to keep the exact same roof over their heads that cost them half the price 18 months ago. They then stop spending in the economy, which reduces the rate of inflation. I'm not saying this is the wrong approach. You can't just let inflation go wild and unchecked. But I just want to acknowledge that behind all this economic theory and these papers and numbers are real people facing scary situations. The one thing I will say, though, is the longer that this goes on for, the more people are sucked into this mess. This is why I think people are so mad we didn't see more decisive action from the Bank of England early on to tackle the inflation problem quickly, to rip off the plaster, if you will, rather than just dragging it out. So what happens next? Forecasters thought that we would see inflation jump as we discussed before, and as a result we would then see the base rate rise. The surprise to the downside means many are calling for the Bank of England to actually pause any rate increases. I do think there's certainly going to be more debate for the Monetary Policy Committee tomorrow than there would have been if the inflation number had gone up today. There is already division in the camp. At the last meeting where they raised the rates by 0.25%, the vote was split 6-4-3 against. But two of those actually voted to increase the rate further by 0.5% instead of 0.25%, and only one person on the committee voted to hold. I think we'll see more holds tomorrow, but my gut is telling me that, the rate's still going to go up by 0.25%. I might be wrong. The markets seem to think we're approaching the top of the interest rate mountain. The pound fell this morning on the inflation news, suggesting markets think we won't see many more rate rises. And Ed Conway, the economist at Sky, thinks the chances of a rate rise tomorrow have gone from 80% to 55%.
And there's a 30% chance that it's already raining.